Welcome to Coffee with Joe for Tuesday, November 30th, 2010. Joe, let's talk a little bit again about our monetary policy that we've got in the U.S. today, run by the Federal Reserve. Bernanke's been a little frustrating. He doesn't seem to establish any goals or metrics by which to judge the effectiveness of his monetary policy. Metrics that mean the most to the people on the street are employment numbers, right?
Right. Wages.
But it seems like, certainly the big policy that's getting all the press these days is this QE2, quantitative easing, where they announced about a month ago that they would be buying $600 billion in U.S. Treasury debt over the next, before the end of the fiscal year, which is the end of June. But it's not a very quick way to get the money. It puts the money into the capital markets, and then indirectly from there is supposed to help to stimulate this virtuous cycle, right?
What we really need is wages. What we really need is employment. And rather than have money go into wages, we're having money going into capital markets. We're having money going into, assets. Many of those assets are financial assets, Pete. They're not, productive. It's not a productive use. The chairman, when he made his announcement, he said these measures are anti-deflationary. Okay, they're non-deflationary. They're supposed to be providing some stability from the economy going down. And while that's a needed and worthy type of a goal to have for monetary policy right now, the question is, what's the metric for the deflation? Is it consumer price index? Is it a basket? Is it, what does it include? What doesn't it include? Is it things that relate to people's budgets, or again, is it assets? Is it that they're trying to shore up the financial assets that they have that are losing favor because of international financial market problems? So it's really the failure of having a recognition, Pete, more than anything, of the national economy, the national monetary system, the fact that, the Fed functions to try to keep the national monetary system working towards achieving its goals, which are general price stability and full employment, Pete. So there's no metric. The whole problem, Pete, is that we're still not taking a look at the systemic structural nature of the money system and what's really wrong with it in order to try to get to some real solutions.
The head of the Bank of England, Mervyn, in a speech on October 25th of this year, was talking about some bold reforms to the structure of the monetary system in England. Now, England's an interesting case. It's a member of the European Union, but it has managed to stay out of the European Monetary Union, and it has maintained its own currency, or as you would say, it's maintained its own monetary sovereignty. In his speech, he actually is talking about the possibility of eliminating fractional reserve banking. In essence, these proposals recognize that if banks undertake risky activities, then it is highly dangerous to allow such gambling to take place on the same balance sheet as is used to support the payment system and other crucial parts of the financial infrastructure. And eliminating fractional reserve banking explicitly recognizes that the pretense that risk-free deposits can be supported by risky assets is alchemy.
Beautifully said, Pete. Beautifully said. I have to take my hat off to Mervyn because, he's a guy out there. He's just another one of the global, the world's central bankers, Pete. And yet he is willing to really look around for what is the cause of the problem and what needs to be done about it. You don't hear any of the other central bankers, Pete, the European central banks or the other national central banks, talking in terms of having a change in the way money, because there are many aspects of fractional reserve banking, Pete, that are problematic, and that by moving away from it to assumingly full reserve banking, narrow banking, where people put their money in the bank for a purpose and for a term, and are willing to accept a payment and a risk, on the basis of their money being used. And those who don't want to take any risk, having a place to put their money in, and again, without a need for the federal government, to step in and to create, some moral hazard into the equation. Those things would greatly restore economic stability. Take the alchemy, take the risk, take the using of other people's money to have private gain for the bankers. All of that would be gone. But the only thing that it doesn't do, or at least he hasn't said how he would do it, is to talk about how do we have money created in that case when we've done that, because fractional reserve banking, what it does
is
the
source of 95% of our circulating medium.
I would say closer to 100, but
yeah.
But yeah. So the fact is that he's really, to be honest with you, Pete, he's doing a great service to the banking industry and to public policy by making a statement like that is very clear. There is a movement afoot in Great Britain, by our friend Ben Dyson and in company with the New Economics Foundation and others. And they've made submissions to the Commission on Banking Reform, but they have looked at restructuring the banking industry, Pete, in Great Britain, and basically the proposals that are being made by the positive money people are very much along the lines of the American Monetary Act here in the United States. So what would really be great is if we could tie this all together by Congressman Kucinich. Being able to command some accountability on the part of the Fed, Pete, not kicking the can down the road, just covering everything up, but really taking a look at the structural, problems that we have and fixing them. And I hope Dennis Kucinich can start to do something like that.
Joe, we're out of time. You better get to it pretty quickly because he's only going to be the chair of the House Banking Committee for about another 6 weeks.
Yeah.
So,
yeah. Well. Let's hope so. I totally agree.
Joe?
All right, Pete. Thank you.
Bye.
Take care, Pete.